Hello and welcome to Jim Dalton's presentation with a follow-up to our webinar last week. Do you see what I see? It's April 15th, 4:30 p.m. Eastern. We'll go for about an hour. This webinar is being recorded. Also, if you're coming in, there's a lot of people just coming into the room. The slides for this presentation are at jdaltontrading.com where you registered for the webinar. Right at that post, there's a link and you can click to download the slides. Okay. And it's great to see you all here, so thank you for coming on. This should be a great presentation. We've got some fun stuff to add to it with the 2-wide, or I should say the 3-wide and the 4-wide structure. So it should be very interesting content. So thank you all for being here, and I will turn it over to Mr. Dalton. Hi, Jim. Let's see. Can people hear Jim Dalton? Yeah, I can't either. Okay, that helps. Great. Thank you, everyone. And Jim, before just one item, Jim, before you get started, Michael, I don't send the recording out. I may do that through our email server, but to not inundate people with emails, I upload the recording at jdaltontrading. Really right after the webinar. So within a couple of hours, if you go to jdaltontrading.com, you go to resources, webinars, and then recorded webinars, it'll be the top webinar. The most recent webinar is posted. So just check back a couple hours after the webinar. Once it spools through YouTube and Vimeo, it'll be at our site. Okay? And yes, the webinar Vim is for last week is recorded at our site. All webinars are recorded, or if you prefer to watch it on YouTube, it's at our YouTube channel. Okay, so I don't want to take much more time with that, but I just wanted to get those questions answered. And Mr. Dalton, we'll turn it over to you.
All right, thank you very much. We may vary slightly from what we had planned to do, and the reason for that is there was so much information in yesterday, overnight, and today that it covers a wealth of information. The commitment we made when we started doing educational courses many years ago was to teach you to trade via an understanding of those people that you are constantly competing against. We know from a lot of anecdotal evidence that the majority of short-term day traders do not make money. To compete in that world, there are a few people that make a lot of money. There's a lot of people that find it very difficult, and they find it difficult because they are looking at the wrong information and they get too addicted to price. So before I show the first slide and start talking, remember we're trying to frame this from the point of view of understanding the people you're competing against, understanding their behavioral characteristics, and how that can give you a trading edge and make you very effective. It takes patience, but it's clearly not about numbers, it's not about ladders. Okay, let's get started and see if I can make this come to life. Okay, the first slide you are looking at, on the far left side, you are looking at Monday afternoon's rally high. One of the references we look at when you get a trend day down, one of the references we always look at is the afternoon rally high. If it was a trend day up, we would look at the afternoon pullback low. In this case, we are looking at Monday afternoon's rally high. Additionally, if you notice on the bottom, we had a poor low, meaning there was no single prints on Monday. So the chances are that that low gets taken out on Tuesday. Overnight, Monday night, the overnight high was exactly to the rally high, afternoon rally high from Monday. Yesterday's high was just 3 ticks short of the rally high from Monday. So what were short-term traders doing? Mechanically, they were overnight, they were selling at the afternoon rally high. They were doing the same thing yesterday. So it's a very mechanical type of response from traders. Notice also that the poor low from Monday was taken out during the pit session on Tuesday. We came back up late in the afternoon. We were up against this reference. We didn't take it out, but you can see late in the day how close the market came. Again, we rallied up there. So you all don't get the nightly reports. I do. I only do them for a couple of people, a couple of institutions. You will, if you sign up for our intensive, which for all practical purposes starts May 1st. Its build is starting on June 1st. Because starting June 1st, we will do webinars almost every day, in addition to a nightly report and a morning update, as well as real-time blog. It's a one-way blog where I blog important information throughout the day. And we will start.
It's really a chat, Jim, just so it doesn't get confusing to people.
I'm sorry. It's a chat. It's a one-way chat comment. We will start that on May 1st for people that sign up for the intensive that officially starts on June 1st. Reason I say that, this is the report that I did last night. It's not the exact report, but this is the words. Likely heavy stops just above the 2092.75 level. And what was in my head was this was a short covering rally from yesterday. There's the P formation, and it was a relatively weak rally. But the traders were selling just like they did on Monday afternoon. And I'm looking at this last night. I said there has to be a tremendous amount of stops right above this level. And knowing traders, if I can see where these stops are, I can figure it out. My guess is there's going to be a lot of traders with a lot more trading money than I have that figure it out. So I thought the chances were pretty good that reference would be taken out either this morning or overnight. So my position last night was going home long. Okay, let's go on to the next slide. What happened overnight? There's the reference we were just talking about. It's the red line, 2092.75. The market gaps open and trades substantially higher right off the bat. Now, you may say, but Jim, Tuesday was actually a weekday. Tuesday was a weekday. You have a very prominent point of control, which has high odds of being revisited. Why would the market gap higher and then immediately go higher this morning? The answer to that is simply the market has to take care of current business first. The current business was these traders from Monday afternoon, overnight on Monday, as well as yesterday, were carrying positions that were too short coming into today. They were forced to cover overnight, and no, they didn't cover. Only some people covered overnight. A lot of people don't trade in the overnight markets. So once the market opened this morning, and you get a gap opening, there are a lot of people that have margin calls. They have a panic feeling. They have to get out of these positions. So the expectations are that once that market opens, the market is going to go higher because of forcing action or the requirement that these people have to cover their shorts in order not to get margin calls. Now, I want to step back and I want to do a little better review of Monday. This is Monday. What I already talked about on Monday was this reference in the afternoon. So we had that reference. But additionally, on Monday, we had an anomaly, an anomaly, an anomaly, an anomaly, an anomaly, an anomaly. Those reference, when you have a profile like this that is not smooth in shape or structure and the market's down, that is more than likely an indication of emotional selling by shorter time frame traders. It is not an indication of new money selling or stronger selling. So more than likely, all of this trading on Monday to the downside was weak emotional liquidation and selling. It was not lasting selling, and it had high odds of being retraced. Now, before we go on to complete this example, what we're going to see later, I will take you through, we don't have it in this chart, but I will take you on a real time later and show you that Tuesday's market was weak. It has anomalies below it, as well as an anomaly with a very fat, prominent point of control. So the chances are pretty reasonable that we're going to come back down through what we saw on Tuesday. Usually it doesn't happen right away. It doesn't happen right away because, like I said this morning, the market had to take care of current business first. Once the market traded higher, the shorts were caught, and those shorts then had to cover. So that was the market's current business first. Now, on the far right-hand side, you are looking at the second pullback this morning. First pullback, the B period went just 3 ticks below half back, then it rallied sharply, not to the high. C period came exactly to half back, to the tick, and rallied. My question is, when a market, or statement or question, when a market goes exactly to half back, who knows that's there? Who is buying at exactly half back? It is not the longer term money. They don't even know where half back is. When I see a market go to half back, it's an indication that I am looking at weaker hands, day and short-term traders that are looking for mechanical references. So once I see this exactly at half back, I think that there's a pretty good odds that we're going to come back through that reference later in the day. Okay, so that's what we call a weak. It's what we call a weak reference. Just as we would call Monday a weak reference because we had the pullback high, the overnight high was exactly the same, and Tuesday was just 3 ticks away. So it was relatively a weak high. Relatively, it was weak is an indication it was a high that was made by day and short-term traders, the weakest of hands traders. Now, there's the slide. I took this capture as of 11:14 this morning.
Yes,
and we understand.
Jim, can I just say something? I just want people to know Jim was capturing these as he's trading it, thinking this is great for the webinar because this is with the topic. I added the bigger type and all, but he's capturing this. He doesn't know how to do replay in Window Trader. He just grabs it when it's live. So these are live captures that you're seeing as he's trading and preparing, knowing what we're going to be talking about this afternoon. I just want to put that in because this wasn't cherry-picked or replayed after the fact. So thank you, Jim.
And that's why, as I took the capture, that's why I put the time on it right there. So I'm looking at this and I'm saying, pretty good odds we're coming back down through this. Now I didn't know that. I didn't know that at the time, but I thought there were pretty good odds, and I wanted to have it captured. Okay. I took another capture. I think this is only 6 minutes later. So it's 11:20 a.m. That'd be Eastern time. We have come back down through half back. So the D period takes out the C period, weak low. So when that market rally, as a short-term trader, how do I use these things effectively? When I see this rally off of the B period high, as a short-term trader, what I'm trying to do is sell the rally. Now, some of you that are familiar with what we do would say, well, Jim, that's totally inconsistent with everything you've said, because value is higher, and on a day like this, you want to be buying breaks and selling rallies. Basically, that is correct. Basically, on a day like this, you want to be buying breaks and taking profit on rallies. In effect, I was doing that because I came in, if you remember, I said I came in to today long. I came in with 2095 strike price calls. So when this market, when I see this and the market rallies up here, I go short against my calls. And I'm not trying to teach you options. I'm just going through the mentality so you understand. I saw this as an opportunity to sell against this short the market. And you saw the first slide. Now 6 minutes later, we have come back through that level. Okay, the next slide was taken at 11:52. At that point, the green dot down here is the opening. So the break came down exactly to one tick above the opening. So it is another sign of weakness. Who bought at that level? That's day time frame and short-term traders, and maybe some people that hadn't gotten their shorts covered. It is a weak response. However, we're going to add a little more complexity to it at this time, because by this time, the market has already gotten fatter up here, and there's a better odds that the price will get, because of that fatness, there's a better odds that the price will get pulled back to that level. However, it is still an indication of a weak response. Knowing that I have another weak response, what is in my head is that I am more than likely going to get a weak close today. It doesn't mean it's going to come back and take that out, because it's gotten very fat up here. But the odds of getting substantial upward continuation have lowered considerably. Doesn't mean it doesn't happen. We are talking about looking at the markets from a point of view of odds trading. Okay, now before I go on with other slides, I'm going to minimize this, and I'm going to come over, and I want you to see the final of the market today. We had a very prominent point of control down here.
Can you make that just a little bigger, Jim? Pardon me.
At a very prominent point of control down here, and I thought there was a pretty good chance that we would break down to that level. Remember, this low was exactly to the one tick above the opening. Another sign of weakness. So I had a sign of weakness in the morning when we went exactly to half back, then through it. Another sign of weakness when the market came exactly to the opening. One tick above the opening.
You want to mark the opening, Jim? Or?
It's the green.
Just so they see it, just mark it. You don't do it on the axis, though. Yeah. Thank you.
Okay. So I had in my mind a pretty good idea that it was going to rally from here, because that's what short-term traders do. Once they get the half back, they buy. When they get to the opening, they buy it. But we've gotten fatter up here. Now, late in the day, in H period, now you have some other things that you have to deal with as a trader. And the other things you had to deal with is that you had oil making a substantial run. It was up almost $3 at one time. And you had the dollar index breaking 4 handles or so. So those type of things added another emotional level to the buy side of the market. So short-term traders were getting very emotional and buying this market and hoping for, you can just see that here's the There's the all-time high. So you can just see traders this afternoon, they were just so greedy, thinking we're going to go to the high, we're going to go to the high. They got long again. Now, what I also want to show you, I marked the A period, 21:02:25. Notice the A period high, which was the early morning high. That now becomes support. I period pulls back to 2 ticks above the A period high. J period pulls back to a single tick above the early A period high and rallies. K period pulls back exactly to the A period early morning high and rallies. Who do you think is buying? Again, it's a sign of a weak reference. Who, again, do you think is buying exactly or within a tick or so of the morning high? That is not long-term money. That is short-term money trying to get exactness. Well, what did they do? They just got themselves longer and longer and longer. So when I'm looking at this and I'm watching the I period, J period, K period, and L period, when this thing rallied in L period, I went back fairly heavily to the short side, looking for a liquidation, nothing more, but looking for a liquidation back to the point of control as the market closed down. Because I'm saying they're too long. But understand, this is another example of a weak reference. Who got the exactness? Exactly, go exactly to it or within a tick of it and they buy it. That is people, those are weak hand traders, and they're trying to be exact, and they're trying to, to eke out their living that way. It is very unlikely that that is going to be lasting. And you see what happened late in the day. You got the liquidation. This liquidation late in the day was basically these late buyers up here, the laggard buyers up here. Now you say, but Jim, there's no excess on the high. You're absolutely right. There is no excess on the high. So we have a poor high. When do poor highs develop? It is not uncommon for poor highs to develop when a market is too long in the short time frame. Okay, we've been at this about a half an hour. We've covered a wealth of information in here. Before I go on, I want to go back and I want to review yesterday. But before I do that, I want to open it up for questions, Julia, just on what we have covered so far today. This is a wealth of information. And before we take the questions, I said the other day on the webinar, this is the biggest advantage, understanding these references and the activity around these references and the importance is the biggest breakthrough I have made in trading in 10 years. One of the commitments we made early on, we started doing educational programs, is that we would never hold back any information, that we would share with people exactly everything we knew. I had to wrestle with myself when I finally realized the importance of this a few months ago. I had to wrestle with myself, was I truly going to share this with everybody? Because it is so valuable. We made the right decision, but I will admit it wasn't without some consideration. So what we're looking at here is you're seeing very sophisticated information. You're seeing information that I've danced around for years. It didn't really solidify the importance of it and being able to quantify it more in terms of thinking about odds until just a few months ago. All right, Julia, let me take any questions that you might have relative to what we've addressed up to this point.
Okay, yes, thanks, Jim. I get it. I see this a lot of the time. Hold on, I got questions coming in. But I don't take it because I have to, quote, lean into the wind. In other words, step in front of it early. And it goes against the rules of value higher and, more importantly, the one time framing higher. So the short up there in L It was one time framing higher technically because the current 30-minute period has to take out the prior by at least 2 ticks. 2 ticks or more, and you'll see J only takes out I by 1, K only takes out J by 1, L only takes out K by 1, so you start to say, well, it's technically one time framing higher, but you also have to recognize the context, that it's sliding lower. They're buying automatically off the early morning high in A period, and it just requires some cranking in some context there, and I'll hand it over to you with that, Jim.
No,
I do think the poor high was a little tough too, Jim.
It was. But again, what we do so often, we find many more reasons not to do a trade than to do a trade. And so often the trades that we do are emotional rather than thought out. First of all, the market stopped one time framing in E period, it stopped one time framing again in G period. So we know that it really wasn't, it did one time frame, from once the H period started to rally. That is, I grant you, that was one time framing. But a real high confidence market wouldn't have stopped one time framing twice. A lower confidence, a high confidence market may stop one time framing once. Rarely does it start twice. Secondly, this low was one tick above the opening, which also tells you that it wasn't a particularly high confidence, that it had to go exactly to a tick above the opening to get the responsive buyers to buy. That is also very valuable information. And then when you get up here, you then filter in, coming back to exactly to the A period high. And yes, it was technically one time framing, taking out this by one tick, but that is an indication of how weak it really is, that it's so exacting before they buy. So yes, I understand the poor high, and I understand not making the trade, but you can put your stop, not too far above this. And remember, so often, particularly on a rotational day, and the fact that we stopped rotating twice or stopped one time framing once classifies it as a rotational day. So it's on a rotational day. The best trades are going to fly in the face of the most recent market activity. I do not dispute what I've talked to you so often is you're going to be so much better off over a longer period of time by trading with value. On a higher value day, what you want to do is you want to buy breaks and you want to sell rallies. So again, if you didn't short this, let's take a look at something else. Another thing is you're buying the breaks and you're taking profits on these rallies. So you don't have to be shorting into this market to benefit from this knowledge. It could also be, here's what I'm going to use to exit the longs that I'm in. So there's two pieces of information. The biggest piece of information actually is using this to stay out of bad trades. The first thing, if we're really going to become professional and profitable with our trading, the first thing is to stay out of bad trades. So the information we've shown here will help you stay out of bad trades. It also, then the secondary thing is to use it to, and this was a fade on this market. I grant you that the poor high made it tough, but you had structure, you had this mechanical reaction exactly at the A period high. We'll review again. I period 2 ticks above it. J period 1 tick above it. K period exactly at it. L period 1 tick below it. When you see buying being that exact, you got a pretty good idea that's pretty weak hands buying. If I had institutional or even strong short-term money's got some pretty good size behind it, it's not going to be exact. Is that going to be an exacting? It's just not going to be there. Anyhow, good question. I totally understand the question, and I have a great deal of empathy with it. But sometimes the better trades are the more difficult trades that you will have to make. Another question, please.
Yes, thank you, Jim. It was tough to buy the E period low because it was a weak reference. And do you think that because the E, is that a weak reference now? Are you carrying that forward for tomorrow's trade?
Okay, it's a great question, and yes, it would be tough to buy, but if you understand this information we're talking about can actually be used two ways. One, when the market breaks in the E period down to the opening, you have there's a pretty good odds that the short-term traders are going to be there to buy. And if you don't get much lift, then you don't get much lift. But the chances are pretty good they're going to buy there. Just like it's pretty good they're going to buy at half back. So if you buy down there, you can have a fairly tight stop. And but I understand exactly what you're saying. And that's why I said this information can be used two ways. One person could use it and say, okay, I understand it's a weak reference, and I understand that I may not get a lot to the upside follow through, but I also understand it is a place that I could buy. I could take a look at a buy with the market. Because remember, the gap has not, at this time, the gap was not filled. We weren't even close to filling the gap. So the market had still gapped higher. These are not easy trades, and your thinking is perfect. It's just there is another way to do it. And remember, by the time it broke down here, we were also 1, 2, 3, 4, 5 wide up here. And more than likely, you're going to get pulled back to that area. And we're going to talk about that in a little bit later. But it's a good question. It's a fair question. But just remember, depending on how you trade, that could be a point to a buy, knowing that that's what the short-term traders are likely to do. It also, if you are short coming down to that level, those that know me a lot of times will say, I will cover there, because if there's going to be a problem, more than likely that's where it's going to be. So there's a lot of nuances, particularly when you are involved in short-term day time frame trading. But good question. Thank you. Julia, a couple more.
Yes, sir. Thank you. Yes, we do share Jim's screens during real-time hours in the intensive. That's what we do when we're on webinars. It's always on Jim's screen, and he's narrating and talking us through it.
And then the real-time chat comments. What I do is I make comments throughout the day. I may put a typical comment would be the A period high at 2102, whatever it is, and the pullback in I and J period were almost exactly there, exactly the same with K. I might say this is a weak reference. It is not a strong reference. So I will try and point those things out throughout the day. And the reason for those that haven't been part of an intensive, the reason it's a one-way chat is because this is something else I should add here. This is an advanced course. But two things. One thing is when we're teaching this stuff, it's not like learning to play tennis where you can have junior matches and we'll match you against people of equal caliber. When you are going to trade, you are trading against the best. There is nothing but masters tournaments for trading. So to be really worthwhile, they have to be at the advanced level. That's the only way you're going to survive. But one of the things that we hit on during the last intensive, it was almost like having simultaneous intensives. I would talk, with the markets. I would talk with the markets open, and then on most of the days, as soon as I was done talking, or if it was a day that I wasn't talking, Julia was running another at different times, but was running another webinar where she could field questions in order to have those people that weren't as experienced continually brought along to match the experience of the traders that had been in the prior intensives. And generally what will happen, I will be listening in. I'll have my earphones on. It's not my webinar, it's Julia's, but I will be listening in. If there's a point that I have a comment or Julia directs a question at me, then I will feed into that. So this is a pretty deep operation that we run, and it's our intent is to give you everything that we possibly can to pave the way for you to be successful. We have a tendency to over-deliver on almost everything we ever do. Okay, other questions, comments?
Yeah, Jim, Peter Resnick wrote this morning in his update, go with all gaps that are not filled quickly. And I know Peter understood the context here today, too, and was able to adjust. But go with all gaps that are not filled quickly. Does this have much less significance when these types of weak references occur? In other words, C coming down, to half back at the time, and, what you showed on that slide. How do you crank that in with the rule of gap rule, go with all gaps that are not filled relatively quickly?
Well, it's interesting because Peter and I talked extensively last night, and he wanted to clarify the one area of the gap rule. But no, today was perfect to the gap rule. The market gap higher. The gap wasn't filled. He wanted to go with the gap right away. But the more important thing about this gap is when I went back and was showing you, that the Monday high at 2092.75, the overnight high at 2075, yesterday's low just 3 ticks below it, and I showed you the thing where I wrote, heavy shorts. When this gap higher, you understand what it is. You understand what's caused the gap. It's the shorts are caught. And if you understand that, you say, they don't cover, the people that trade overnight are not necessarily the same people that trade during the day. So when this market gap is higher today, you got an awful lot of day and short-term traders that have to cover. And that's why you got this panic this morning. So the gap rules work perfectly. There's the A period. There's the market gaps open, and there's the A period, goes up quite a bit, and that's the short covering. That's the traders were caught short scrambling to get covered. So I think the gap rules work perfectly today. Value is higher. The best trade were to buy, buy the breaks on a gap, but we also showed that it wasn't a high confidence gap. A gap can be because it's high confidence. It can be a change of thinking because it's high confidence. A gap can also be the result of a market that was too short, just like it was coming into today. And we said it was also set up by the way the market broke on Monday. All the anomalies just meaning, there's no smoothness to the profile. There's jagged edges and things along the way.
And it was a minor bracket. It was a small gap, too. I mean, it wasn't one of these 8-10 handle gaps that we see. It held. It held. So we have a question on that, too, Jim, if we can get that knocked out.
I will, but hold on just a second. I want to show you yesterday. This is short covering rally from yesterday. You have a 2-tick low. It wasn't a wonderful low. You have an anomaly. You have another anomaly.
Well,
it was short covering. You had a very prominent point of control. So the odds are going forward. The odds are we come back down and correct through this, just as we came back down and corrected Monday's gap 2 days later. Pretty good odds that we come back down and correct Tuesday's profile. We also have a very prominent point of control from yesterday. We have another prominent point of control today. So we have back-to-back very prominent points of control. So it doesn't mean the market doesn't go higher because it's so close to the all-time highs. The question is, this is the all-time high. The question is, can the market really resist doing that? And for that reason, I went home with a few calls tonight just because can it resist doing that? But overall, the market is not strong. Yesterday was a weak rally. Today was a weak rally. But we don't have any completion. So those are the things. There's no completion to this day on the upside. No excess. Notice we came Monday. We said I didn't like the way the market went down on Monday. I didn't think it was going to be lasting, but there was no completion. Well, guess what? It got completed a day later, and then we got a short covering rally, and then, of course, it gaps higher today. So it's not impossible that in the next couple of days we go down and close this gap and get back into Tuesday's range. But keep in mind, you're so close to the all-time high. It's a question: can the market actually resist going there? Okay, other questions?
Okay, great. And just to make a comment about the all-time high, some traders are asking about, is it 2109? We're using the front month, so we've got the actual contract high, what's actually been traded, and it's not adjusted on a monthly or a weekly chart. So that's why your numbers may be different. But if you use the front month when you're so close to the high, you want to use the actual trading level, not some continuously adjusted contract in a monthly chart or weekly chart, okay? Or at least that's how Jim teaches to
That's how I look at it. I go back and say, this is where the real trade took place, and but I'm really not, I'm really not going to lose a lot of sleep over, a little adjustment one way or the other.
But just technically so they know why these numbers are different.
Correct.
Okay.
Go ahead.
I was biased to the upside after a gap higher and no counter, and went long at the upside breakout of the inside B period, but I was stopped out. Is that a legitimate place for a long or not? Can you make that just a little larger, Jim, so traders can follow along as you're going through this answer? Thanks. Are you talking, Jim?
No, I was going back to find the profile.
Can you put it on current slide?
Oh, how many times are you going to tell me that? Okay, okay.
He took the long in B period.
Okay. Now, I think you said you took the breakout above the B period to the upside. Is that correct?
Yes, it's an inside bar, and he's going with the value. He's going with the gap.
Okay. Here's why I would not have taken that trade. There was half back at the time. B period went 3 ticks below half back. Pretty mechanical. And then rallied. The mechanical nature of this would have kept me out of this, kept me out of going with this trade. At this point in time, I would have wanted to see
in C period. He went long in C period.
In C period, I'm saying.
Yeah.
And at this point in time, rather than go above the B period breakout, remember, C period went down. I don't know what order, but I think C period probably went down first.
Yeah.
And then came up. So at that point, I had this perfect reference down here. No way in the world would I have gone with the C period breakout. If this happened first, I don't remember what order. I don't remember if the C period high was put in first or the C period low at half back was put in first. Whoever asked the question, do you remember?
I'll see if he emailed us, but I'll look for his note here on the chat board.
I believe that the C period low was put in before the C period high. With the C period high having gone exactly to half back, I would have been looking.
Low was made first. Sorry.
The low was made
Yep.
first?
Yep.
Okay, that's great.
So,
with the low made first,
yep.
exactly at that reference. Remember, one of the things I said earlier, going through this information, to also help keep you out of bad trades, in which exactly what this did. And with this going exactly to the half back, no way would I have bought this. Instead, I would have been looking to fade it more than anything else, simply because of the exactness of the reference. I hope that's helpful, but that ties in exactly to what I say so many times. This information can be used two ways. One, it can be used to be profitable, but it also can be used to keep you out of bad trades. And I understand one of the classic trades we talk about is going with a breakout from an inside bar. And your reasoning is fine. You got a gap, you got an inside bar, you want to go with it. But this little piece of information changed all the odds to everything because it was so exacting. Great question, and that should be helpful to everyone. Okay,
Yes.
other questions?
Well, okay. Very quickly, half back is the center of the range. Okay, it changes as the high and the low go higher and lower. You can use our glossary at our website for one time framing, half back, anomalies, prominent points of control. That kind of stuff will help you, just so we can keep it moving forward. And there's a lot of free articles there too, under resources, trading articles. Okay, just to get you up to snuff. Do gap rules work 100% of the time? It seems yesterday didn't play out with the value not similar, late break. Go ahead, Jim. You can address that question, please.
Well, there's absolutely nothing that's going to work 100% of the time. And everything has to be viewed in context. So, well, I don't know. Yesterday, did we gap lower yesterday? There's the opening. Yes, we did gap lower yesterday.
Yeah, and it filled.
We filled the gap.
And then it broke lower, and then it went back.
Then it broke lower. And then they even broke it late in the afternoon. They broke it all the way down. They broke it all the way down to this level late in the afternoon. But by that time, it was too fat here. So no, it's not going to work all the time. But value was lower, and it never really got much on the upside.
If you move that up, Jim, too, and look at the prominent point of control, just to point this out to people, don't make it too small, though. The low of yesterday, if you could slide it up a little, I believe it went to the point of control from, yeah, that fat point of control was repaired yesterday. And you'll see this over and over, and we made this article public. It's article number 80, Forcing Action, but it talks about how these prominent points of control are revisited a lot. And maybe not the next day. You can see that took 2-3 trading days. But it's worthy of note, so you're carrying them forward, just like we're carrying forward the fat point of control from yesterday that the overnight knocked out.
Yesterday and today.
And now today, yes. But we didn't see that yesterday revisited in today's session, but we're going to carry that forward in our analysis and preparation for tomorrow's pit session.
With 2 prominent points of control, let's say the market opens right where it is. Right now it's at 21 even, or 21 whatever that number is, 2101.75 right now. If it opened there tomorrow, the odds would be very high that we would trade lower because of the 2 very prominent points of control. We would say that was exponential information.
Exponential, yep.
Now, the one time we had for those that have not seen the live trading, the live market trading seminar DVD, we were in Chicago, and we had 3 or 4 days in a row where the market went lower, leaving the very prominent point of control. And that was where it finally got just ridiculous, and where I walked in the last day of the seminar and said, you know, this could be one of those markets that open weak and closes strong. And it got overwhelming, that exponential information, and the market rallied 400 points in the last 40 minutes of the webinar and took back all those prior points of control. Now, there's a word that we use, it's called carrying information forward. And what I recommend is you keep a tablet next to your desk, and when you have these items that the market was likely to revisit at some point in time, write them down, keep a log of them, because it's too easy. It's too easy to forget that they're there. And we don't have time to do it today. We will certainly do it when we get in the intensity. But we always start, when we prepare for the following day, we always start with a big perspective of looking at a monthly chart, a weekly chart, a daily chart, and then the profile. We try and gain a perspective from the top down. When we finally get to the daily profile is when we start readying our tactical plan for the following day. And that's when we start to make sure that we've incorporated the information that should be carried forward. Okay, I want to go back to the slides because there's another item I want to cover. There's another item that I want to cover before we go on. Okay, prices and advertising mechanism. Some prices are accepted, some prices are rejected. The most important aspect is who accepts the offered prices and who rejects the offered prices. We are looking at the E-mini from April 13th, And one of the things that we are looking at here, B period comes down exactly to the overnight high. There's again one of these weak references. There's the overnight high. There is the B period low. Then there's the C period low. Finally, B period low, C period rally. C period comes down, takes it out by a little bit, and so it's a weak reference. It's a weak reference. A lot of single prints, but the odds are pretty good that before the day is over, we're going to trade down below these weak references. However, what happened? I sent there's an institutional client that I send an IM to from time to time, and it would be similar if you are a member of the intensive and you're getting the blog or the chat, the live chat comments. One of the comments I sent out was if D period prints at 2097.75, then the market is probably going to spend quite a bit of time in this area. And the reason, so in other words, I'm saying if D period prints here and we get 4 wide at the 2097.75 level, more than likely we're going to spend some time here because that is going to be the fairest price of control, the fairest price. Now, this is complex because we have a poor low, a weak low. We have a good low because of the single prints. We have a weak pullback because it was the B period pullback was exactly to the overnight high. Again, who buys at exactly the overnight high? That is not longer-term money. Longer-term money doesn't even know where the overnight high was. It's weaker money. That doesn't mean it's not going to be worth a bounce, which it was. But as I take that forward, I say that is not a sign of strength. What I'm looking for, do I have a lot of really strong money in the market? Now, additionally, prior to this pullback, there were too many, there was almost 7 handles of single A prints. That's just too many. That spike was too big. That A period was too big relative to the volume and relative to where we were in the market. But what I want to talk about next is the IM I sent out. If D period prints at 2097.75, we are more than likely going to spend some time in this area. And the person came back and said, that's always been a difficult concept for me. I know you talk about that quite often. So what I did, I made these and Julia dressed them up. So will D period make the profile 4 wide, which would suggest more rotation? Now keep in mind, if D period doesn't print at 2097.75, it'll be 3 wide here and it'll be 2 wide here, so it'll have a little bit of elongation. If D period prints here, it's going to be very hard to get any elongation to the downside.
At least initially.
Yeah, well, D period does print at 2097.75. We did look below this overnight high, but again, we have exact matching lows in C period and D period, not particularly a sign of strength. So at this point in time, what I'm saying to this client, more than likely, we're going to spend some time churning around in this area. There's the market. Let me go back one. That was at 11:01 that I took this capture. And again, as Julia said before, these are captures I took as I'm watching the market and sending out the IM. She dresses them up later. Okay, I took this. I think the first one 11:01. This is 11:19. So you see that the market is churning around there. Here's 11:31. Guess what? We're still churning around there, right? No real commitment down here, but we're still churning around there. Now, what I want to do, so remember, early on, I thought there were too many single prints. This reference came down exactly to the overnight high before they bought them. It did not feel like much strength to me. Notice somebody mentioned one time framing before. Since the B period high, one time framing, one time framing, one time framing, one time framing. We are one time framing lower. So we've got a weak reference. It's awfully easy to lose perspective of this. Now let me go to the market overall. And I'm going to go to, what day was that, Julia?
Which day? April 13th, Monday?
Okay.
No, we're still on, yeah, it was Monday. Beg your pardon.
Okay. There it is. So
can you make it a little smaller, Jim? It's no context. It's hard to see anything.
That we started to say before. Hard to see. One time framing lower. E takes out D by a single tick. Still one time framing lower. One time framing. One time framing. Somebody's talking earlier about the inside bar. Remember, we said around this D period we would spend time, which we did. Made the D. We said if D period printed there, so it spent between D, E, and F. It spent about an hour and a half up here, just churning around. Then the market got back, and you talk about trades. You can take the F period breakout from the E period, very narrow bar. Inside bar and G, you can take the H period breakout from that. By this time, the market's getting very, very stretched out. But one of the things that happened in here, and we don't have it in this chart, we have it on another, the I period low, this low in I period right here, was a single tick below the overnight low. Again, another weak reference. So the market rallied. These two highs matched. The market then made another break to the downside. Okay, we've covered a lot of information today. We've been at this about an hour. Julia, let me take a few more questions.
Great, thanks, Jim. What were Jim's three various possibilities for today, for the morning? I know the one gap, and was to go with the gap was the highest priority, or at least a dominant scenario. What else were you looking for? He's looking for confirmation of what he wrote up.
Uh-oh, you caught me. I am very, very embarrassed. I only had one scenario. You just caught me in a huge violation of everything I teach. I'm very sorry, but in my mind, I guess I was just so positive that they were going to gap higher, and then a lot of times what I do is I'll adjust my scenarios when I see what's happened overnight. But the one I went home, I think I told you I went home long calls, and I went home my full commitment of calls because I really thought that was going to happen. I just couldn't believe the market could resist taking those stops. So I was very guilty that I only had one scenario, and that one scenario was the gap. Shame on me. I wish you hadn't asked that question, and I wish I would have lied. I would have felt much more comfortable. But when it gapped higher this morning, and I saw that in the overnight, I didn't change anything. Sorry.
Okay, that's all right. Jim, when revisiting a prominent POC or repairing it and bouncing or, reversing, would that be considered a weak reference? That's a different context. That's a reference outside of the pit session. It's repair of a prior poor structural point. It's not the same.
It's a great question. It's a great question. And it's a great question, and there is a tremendous similarity to it. Again, you have to look at the context. Let's say that the market is really breaking very hard, and you get a last spike down, and that last spike goes right to that point of control and then bounces, and the rest of the day is spent higher. We may come back to that point, but I don't think I would record it too much today. But it's something you should record, because the fact that it could get there and it went to an exact level is something you should record. More than likely, it's not going to, if it came from a long way away, more than likely it's not going to be relevant immediately. But if it's coming from a shorter distance away and it goes exactly to that Ferris price, then it's more than likely going to be considered very similar to a weak reference. It's another great question. The answer is very complex. It really has so much to do with where was the break coming. You get a real strong break, and that's the only place it finds the stop, and it bounces sharply. Probably not going to be a while before it comes back there. Good question. Thank you. Another question, Julia.
Yes, thank you. Do you take into consideration the high volume clusters versus the TPO, conventional structure of support and resistance? So for example, today, if you make that a little larger, we have, the volume POC was about the same as the conventional TPO POC. But the point is, yes, on the edges, if we see high volume come in, and it can't really break above it, it starts to slide below it, that can be very helpful. But in terms of the nightly analysis, Jim is using conventional structure with the TPOs. But certainly, high volume that sticks out in the day, and yesterday we had high volume up at, I think it was a few ticks off the high, and it came back up there, and they just smacked it back down off of it. It did act as resistance. Jim, go ahead if you want to take a shot at that, but that's yesterday it happened. If you replay that,
that's the reason. That's the reason I went back over here, because yesterday morning, as this market was rallying, we got a lot more volume here later on. But notice the earlier volume, 6 is the biggest. 6 is the biggest. You didn't get down to 10 until you had, multiple time periods. On the rally in the morning, I did notice that there was 8,000 cars here and 8,000 cars here, and that did catch my attention because the market didn't carry through to the upside. It's more than likely
it was sellers.
More than likely that was sellers, and that's pretty good size order. So I did pay attention to it yesterday. There are no absolute rules to what we do. We're looking at nuances all the time. As a general rule, I pay more attention to the TPO point of control, and the reason being the TPO point of control incorporates both volume and time. A volume TPO does not incorporate time, and the market price advertises opportunity, time regulates all opportunities, and volume measures the success or failure of those advertised opportunities. So time is an extremely important component to me, and that's why I have elected to use the TPO point of control rather than the volume point of control. But that doesn't mean that I don't look and say I only have 174 contracts on the low, 839 here, and I've got 8,000 up here. That's just common sense to say, okay, what was going on? If this was buying volume, we're not going to stop right there. And I said this was some pretty good selling at that level early in the morning. Okay, great question.
Great. Okay, great. Thank you, Jim. Can Jim share what possible scenarios, Jim, do you suggest for tomorrow while considering today's weak action?
Great question. Let me go back to, the problem with
the software we're using now, excuse me, Jim, just a couple of questions on this, is Window Trader Blue. You can see that as a resource at our site. We have a bunch of market profile platforms listed, but windowtrader.com, there's no W in the Window Trader. It's just DO Trader, but that's what we're using here. Go ahead, Jim. Excuse me.
What I can tell from the questions that we have some people that have been with us over the past, because the questions they're excellent questions today. Probably the best questions we've ever had. Of course, Julia's sitting there filtering them too. But the scenarios for tomorrow. First of all, here's the factors I'm going to go into my mind. One, I do not have any completion on today's profile. No excess at that level. I also know
Poor high.
that poor high today, meaning no completion to today. I also know that I'm easily within striking distance of the all-time high.
Jim,
and I'm not,
can I make a correction? It's my mistake. The all-time high on the front month, if you slide to the right more, you get over to the left, it's 2109.75, so I'm sorry. That is not the all-time high there, Jim. Back a few more days, it goes to 2109.75.
I'm sorry.
So that is, but you've got this is a poor high. If you look, no completion on a daily bar. Those are matching daily highs there at 2107. So those were beckoning the market back. There was no completion to the breakdown from there before it broke down. But anyway, go ahead.
No, thank you very much. And
someone pointed it out to me. Thank you, Bill.
Yeah. I'm just trying to get rid of some of this stuff.
And make it a little larger too, Jim. It's awfully small.
Okay.
Collapse that profile there so it's not split out. Like get rid of that. Just to cancel. Just to cancel above the profile.
Okay. You talking about this one?
Yeah.
I don't know how to do this one. I don't know how to cancel that one.
No, you can't. That's just the profile setting.
Okay. All right. So here's the consideration that's going to go on. First of all, I have no completion or no excess on today's profile. I know there's no excess up here at the 2107 level because those are within 30 or 40 cents of each other, those two highs. So a possibility, one scenario would be to look above there and fail and come back down. Of course, another scenario is just go and take them out and trade higher. Clearly a potential. But more likely scenario, look up above there and fail and trade back down because I've got the very prominent point of control from today and a very prominent point of control from yesterday. That's important information. In other words, this market's trading higher, but it's really struggling to go higher. So scenario one would say, I mean, the market can just go straight up and go. Okay, that has to be a consideration. If that were to happen, what you would do is you would see high confidence from the opening. You would see the market would open. It would probably have high confidence. You would probably have fairly high volume. Your first half-hour volume would probably be someplace in excess of 500,000, and based on the NYSE composite volume. Okay, scenario two. Look above the highs and fail, then come back down and revisit the very prominent point of control today and attempt to get in the gap. Scenario three is just to trade lower, start to trade lower because of the two prominent points of control that we have from today and from yesterday. The ideal short would be for the market to trade above the prominent point of control to open and then trade lower with some conviction. The ideal long would be to trade below this point of control and then come back up through it with some conviction. So this is what we call sequencing. When I have a very prominent point of control like this, sequencing becomes important. Do I open down here first and come back up? Do I open above it and come back down? So the sequence in which things happen relative to this very prominent point of control will be important. And what I'll do is I look at what's happened overnight, and then we get the 5:30. We've got the 5:30 my time news. We'll take a look at that, and then I'll adjust any scenarios. All right. Let me say thank you. We're really we're doing 9 of these. It's all free education. We are hoping that a lot of you will attend the intensive. Like I say, it begins on officially begins on June 1st, but for all practical purposes, we start with the reports, the 2 reports a day, as well as the live chat, beginning on May 1st. So it comes as close to giving you 9 weeks of information as you can imagine. The real value, and for those that don't know, I was always somewhat frustrated when we would do seminars, because if you're doing a seminar in a hotel room and things, and it may be a great seminar, but you don't see that many different market situations. And I was frustrated because people loved them, we got good applause and everything, but I really didn't feel we were giving people what we should be giving them for the money and the time and effort that they expended. Julia came up with the idea of the intensive and spreading it out. Initially, we spread it out over 2 months. 2 months was a little more than I could handle. I'll be 75 this summer, and 2 months just wore me down, even though this time we're going to be 9 weeks. But I'm only doing seminars. I'm only doing actual, daily seminars, the
Webinars.
month of webinars, I'm sorry, webinars, the month of June. So hopefully that's a little less. But the value was to be able to see, and what her idea was, I really loved her idea, and the more we've used it, the more excited I've gotten about it. It gives you a chance to be exposed to multiple different things in the market. And the people we've worked with in the past have said, and I'm talking about people that a lot of these people I'm talking about made the conversion from being floor traders to trading upstairs. And only about 5% of the people that were successful on the floor have been able to make the transition to trade upstairs. It's a different ball game. But those people that have been successful continually say, you can't hear what Jim has to say enough. And it was amazing last night when, I spent quite a bit of time on the phone with Peter Resnicek, and we were talking, and he said, I'm just amazed as many times as we've talked and I've been to your programs. He said, I always come away with a couple of more things that I really had either forgotten about or just hadn't caught the first time around. And I think that's so true with what we do. And the intensive allows us to show those things over and over again, and to catch a lot of things you might normally not see in a shorter educational program. Then the other thing, as we mentioned earlier, that got added to the last one, and it was really kind of by chance, with Julia doing some seminars following what I was doing, in order to assure the clients, those that weren't as advanced as some of the others, that they had an equal chance to catch up. And the webinars that Julia was doing, I noticed the attendance was very, very large. We had many. It wasn't uncommon to have 60 to 70% of the people attending her webinars also. So there was a double bang for the buck. But anyhow, we really hope that you'll join us in there. And like I say, if you don't, we've still got 8 more of these free ones coming up. But if you do join us, we promise you we'll give you everything we possibly can. Julia, you got anything to add?
No, that's great, Jim. No, we do. The issue with this in an intensive, you got a lot of people in there, and you've got people that are very familiar with Jim's process. You have veteran traders coming in and learning it. You've got new traders just out of the blocks doing it. So we can't slow down. It is an advanced course, and we can't ask rudimentary questions during, Jim's webinars, because it's frustrating to traders who want to take it to the next level, and they don't want to get bogged down. But at the same time, we want to accommodate traders that haven't watched the field of vision, haven't really heard this that much. So we thought it would be very helpful to have these Q&As where I can just sit there and field a lot of questions and everybody listens. We interviewed one trader who's been with us, and people asked him questions, and we just talked. It's kind of spontaneous, but it does help everyone get up to speed quicker and get the most out of the intensive that you can. I mean, the whole purpose of the intensive is to accelerate your learning, collapse the learning curve down so you're absorbing all this in a 2-month period of time through reports, morning and evening, through intraday chat, seeing those comments and a ding on your browser. You hear a sound when Jim types something in, through the webinars, and through reading the archive of articles and watching past webinars. We've got both past intensives up there, so you can see the October break from the fall intensive where we had the 10% break. You can see the New Year intensive. We're just trying to help you. I mean, people say it's an avalanche of information, but if you want to learn, the content is there. And you can take it in pieces to really bring it together. So when you come out on the other side on July 2nd, you're going to have a completely different perspective and have these things in your tool belt to pull out in real time. And yes, it takes time to learn how to use the tool correctly, but you know it, you have it, you've seen it work, and then you just start incorporating into how you trade, because obviously we have to trade our own methodology and, you know, use Jim's, as some use it more than others, but you have to make it your own. So that's all I want to say about that. But it's great having you all here, and we appreciate everyone stayed on till the end here, and we'll keep having these leading up. So if you're interested, you'll get the information to make an informed decision. And if you just want the free education, we're happy to provide that to you as well. So thank you everyone for being here, and thank you, Jim. Great job. It's complicated stuff, we know. But we appreciate that was well done, sir. Thank you.
And the final thing is, as Julia wrote up, I get approached all the time by people that you know, are talking about individual mentoring, and I say, you know, it's cost prohibitive, because to really give any meaningful individual mentoring takes a long time. And what we hopefully have designed a course here that puts a reasonable tag on a substitute for the very expensive and prohibitive individual mentoring. Anyhow, thank you once again, and we'll see you in a couple days. Bye now. Julia, you still there?
Oh, beg your pardon. Yes, everyone, and just to remind you, we have a webinar on Monday at 4:30 p.m. That's April 20th, and we're going to change the times up a little, so if you see the schedule for our European friends out there, we have several at 11:30 a.m. Eastern, which is the European close, so you're not watching these at 9 o'clock at night, 10 o'clock at night. So check it out, and we've got one at 9 a.m. as well, so we can see some real-time trade. So come on back, and everyone, God be with you. Have a great night, and thank you again very much for being here. Good night.
Thanks.